Welcome friends on the video lecture initiatives of Board of Studies of ICAI on Accounting Standard 1, which talks about disclosure of accounting policies, of Chapter 1 Accounting Standards, of Paper 1 Accounting of CA-IPCC Curriculum. I am CA Alok Kumar Garg, your mentor for this. So Accounting Standard 1 Disclosure of Accounting Policies. This standard is very important from real life as well as from the examination perspective for CA-IPCC curriculum. This was the first standard which was notified and which was issued by ICAI in November 1979, and this standard is applicable for the accounting period beginning from 1st April 1991. So the agenda of Accounting Standard 1 Disclosure of Accounting Policy is objective. So we will learn what is the objective of this standard. So why this standard was issued, accounting policies, what is meaning of the accounting policy, areas where different accounting policies can be used. So what are the different accounting policies and which are the areas where it could be different, consideration in the selection of accounting policies. So what should be kept in mind while finalization or selection of accounting policies. Fundamental accounting assumptions. So what are the basic assumptions, what are the fundamental assumptions which has to be there while preparation of financial statements. Then disclosures, what are the relevant disclosures related to accounting policies. So Accounting Standard 1, which was the first standard, which was the first accounting standard, was issued in November 79 and applicable from the financial period beginning from 1st April 1991. So this standard is applicable to every entity. This standard is applicable for level 1, level 2, level 3, so every kind of entity. So the objective of this standard is to promote better understanding of financial statements established through an accounting standards. So this standard deals with disclosure of significant accounting policies followed in preparation of financial statement. So the prime objective of this standard is to describe, disclose the significant accounting policies. So accounting policies are nothing, these are rules, method, principles, mechanism which are used for the accounting and reporting or reporting of a financial statement of an entity. So this standard describes how the accounting policies are going to be disclosed in financial statements and what should be the manner of disclosures. So the first thing is which significant accounting policies needs to be disclosed and how those policies should be disclosed. So what should be the manner of disclosures. Now coming to accounting policies. So accounting policies refers to specific accounting principles and the methods adopted by the enterprise in applying these principles in the preparation and presentation of financial statements. So before learning the definition of accounting policy or before understanding the meaning of accounting policies, let us understand what is the relevance of this standard, why this standard is issued. So the accounting policies refers to the rules, principles, method and mechanism which is used in recording the transactions or in reporting the transactions of an entity. The difference in accounting policies can lead to difference in reported information in the financial statement of an entity. For an example, there are two entities, entity A and entity B. So 5 years ago, both the entities has purchased a land and building in a particular area of New Delhi for rupees 50 lakhs. So the cost of the land and building is 50 lakhs. But entity X is using cost model as an accounting policy for valuation of land and building. So the carrying value of land and building in the books of entity X is 50 lakhs. Entity Y is using revaluation model of accounting policy for valuation of land and building. And the market value of land and building of that land and building is 5 crores. So the cost was 50 lakhs, the market value was 5 crores. Since entity Y is using the revaluation model, so entity Y, the carrying value of land and building in the books of entity Y is 5 crores. The carrying value of land and building in the books of entity X is 50 lakhs. entity Y 5 crores. So both have purchased the same land and building at a same time at same place, and the market value of land and building of entity X is also 5 crores. But in the financial statement, in the balance sheet, the value of land and building shown by entity X and entity Y is different. So whether entity Y is a excellent performer in comparison to entity X, whether entity Y is performing very good, whether the financial position or statement of affairs of entity Y is very sound. No, this is not correct. The only difference between this 50 lakhs and 5 crore is difference in choosing of a different accounting policies. So while valuation of fixed assets, the entity can carry those fixed assets at a cost or by using a revaluation model. So entity Y has used a revaluation model, entity X has used a cost model. So the using of or choosing of different accounting policies may lead to stakeholders in a different manner while understanding the financial statements. So accounting standard 1 comes into the picture, and accounting standard 1 states that the entity has to disclose the significant accounting policies while preparation of financial statements, so that the stakeholder and user can understand that the value of land and building of entity X is rupees 50 lakhs because the entity X is using cost model while valuation of fixed assets, and the value of land and building of entity Y is 5 crores because entity Y has revalued its land and building. So now coming to the definition of accounting policies. So accounting policies refers to specific accounting principles. So what should be the specific accounting principles and methods adopted by the enterprise in applying these principles in the preparation and presentation of financial statements. So specific accounting principles means like accounting standard 10, the standards on fixed assets. The name of standard is property, plant and equipment. It allows an entity to use a cost model or a revaluation model accounting policy for valuation of fixed assets. So the accounting principle is either using a cost model or revaluation model. The methods adopted by the entity in applying those principles. So if the entity is applying a revaluation model, then what were the methods which the entity has adopted for valuation of that particular fixed assets? The principle means depreciation needs to be provided over useful life of the assets. So once again, an example of principle is like depreciation needs to be provided over useful life of the asset. So when the entity is using the asset got depreciated, and that depreciation needs to be provided over the useful life. How that depreciation needs to be provided? So it is a principle that depreciation has to be provided, but whether the entity has to use straight line method, written down value method, or any appropriate method which needs to be applied for providing depreciation. So this is a difference between principle and method. So in nutshell, accounting policy refers to specific accounting principles and methods adopted by the entity in applying those principles in the preparation and presentation of financial statements. Now coming to areas where different accounting policies may be used. So in the previous slide we have discussed one area, that is valuation of fixed assets. So there are two alternatives, there are two choices given in the standard. Either the entity can go for cost model or the entity can go for revaluation model. So by opting these two different alternatives, the answer or the valuation of fixed assets, if comparison provided between the two entities, it will give two different answers. So there are various policies, various methods which can differ from one entity to another. Why? Because of alternatives are available in the standard, or where the accounting guidelines have not been prescribed, then an entity is free to choose any policy or form any policy going by the industry or some other standard issued by some other organizations. So there are some illustrative list of accounting policies which is as follows. Valuation of fixed assets, we have discussed like either cost model or revaluation model. So the entity has to prescribe that which accounting policies an enterprise is using for valuation of fixed assets under head significant accounting policies in notes to accounts of the financial statements. So if you see any financial statement, it starts with balance sheet. After balance sheet, statement of profit and loss is there. After statement of profit and loss, there is a cash flow statement. After cash flow statement, there is a notes to accounts. So under notes to accounts, the first part is significant accounting policies. Then all the schedules and breakups of the items which are there in the balance sheet and P&L account, the detail is provided under notes to accounts. So there are various choices and alternatives given in the standard, and accountant has to make decisions from various choices for recording or disclosing items in the books of accounts. So coming to the second part, method of depreciation and amortization. So entity has to disclose whether it is using straight line method, written down value methods, or let's say any other method like unit of production method. So the entity has to prescribe. Valuation of inventory. So again, valuation of inventory. So there are alternative methods given in the standard for valuation of inventory, like FIFO method, weighted average method. So again, coming to an example. So entity A and entity B is in the same business. So these two entities are sister concern, and these two entities are having same trading model, same business model. So entity A has purchased a stock of rupees 1 lakh, and again entity B has also purchased a stock of rupees 1 lakh. So entity A has sold the stock of rupees 40,000 and they are left with a stock of 60,000. Entity B has also sold out a stock of 40,000 and left with a balance of 60,000. So entity A and entity B both are having a stock of 60,000. Now this 1 lakh stock both have purchased at a different rate, but the rates on which A has been purchased, the same rate B has also purchased those stock. So the purchases are similar, the sales are similar. Now entity A is using FIFO method and entity B is using weighted average method. So while valuing the inventory at the end of the financial year, while preparation of financial statement, so the value of closing stock in the books of entity A is X amount, whereas the value of closing stock in the books of entity B is Y amount. Why? Because A is using FIFO method and B is using weighted average method. So everything is same, the situation is same, the circumstances are same, the prices are same, the manner of trading is same, but the valuation of closing stock is different only due to choosing a different method, choosing a different accounting policy for valuation of inventory. So this policy needs to be disclosed. This is a significant accounting policies and needs to be disclosed in the preparation of financial statement so that a user can understand that entity A has used a FIFO model and entity B has used a weighted average model while valuation of inventory. So this is the reason why the value is different. So the comparison makes sense if accounting policies are provided in a true manner. Coming to valuation of investments. So again, the current investments are valued at cost, whereas the long-term investments, the current investments are valued at cost or market price, whichever is lower, while the long-term investments are measured at cost less provision for diminution other than temporary. So these mechanisms, these principles are given in accounting standard 13, accounting for investments. But an entity has to disclose the significant accounting policies, that what is the policy of valuation of investment, so that user can understand, since this is a current investment, this is a short-term investment, that is why the entity has applied a cost or market whichever is lower, and this is a long-term investment, that is why the entity has applied a cost model. Treatment of retirement benefits. So there are a lot of retirement benefits like gratuity, provident fund, So there are two kind of plans: defined benefit plan, defined contribution plans. So under that significant accounting policies, the entity has to disclose that what accounting policies has been used for the recognition of, for the valuation of retirement benefits. So coming to another example where the accounting policies could be different from, which could be vary from entity to entity, is treatment of contingent liability. So an entity needs to disclose what is the treatment of contingent liability. When an entity is going to recognize a provision, or when an amount or a disputed amount is shown as a contingent liability in notes to accounts. Treatment of expenditure during construction. So while framing a significant accounting policy, the entity has to state that what is the treatment of expenditure during construction period, whether it is capitalized or it is a sunk cost and expensed off. So entity has to state which is necessary for understanding the financial statement by a user or a stakeholder. Conversion or translation of foreign currency items. So while framing accounting policy, the entity has to disclose the accounting policy on conversion or translation of foreign currency items, that the entity is using which rate for conversion of monetary and non-monetary item, for conversion of balance sheet assets and liability related items, and income and expenses. Treatment of lease rentals. So the lease rentals treatment is given under accounting standard 9, which talks about leases. So leases are of two kinds: operating leases and finance leases. So there are two different treatment for operating lease and finance lease. So while framing an accounting policy, the entity needs to disclose that entity has applied which accounting policies, what accounting policies for recognition of lease rentals. So in case if it is an operating lease, then the operating lease needs to be straight lined over the non-cancelable period. So the user can understand by reading the accounting policy that the company has done this kind of treatment for lease rentals. So this list is not exhaustive, this is an illustrative list, and the accounting policy is endless. It depends upon the business of an entity. It varies from one entity to another entity. So these are some illustrative kind of list. These are some illustrative area where there is choices of accounting policies. Now coming to cash flow statement. So the entity is having two methods. The entity either can use a direct method or indirect method for preparation of cash flow statement. So in accounting policy section, the entity needs to disclose that it has used direct method or indirect method while preparation of a cash flow statement. So the basic idea of accounting standards, regulators, Institute of Chartered Accountant of India, or the basic ethics of doing a business is that the financial statement of the entity should reflect a true and fair picture. So the primary consideration in the selection or in the choosing or in the finalization of accounting policies by an entity is the financial statement prepared and presented on the basis of such accounting policies should represent a true and fair picture. So the entity, while finalization of accounting policies or while selection of accounting policies, the entity should be focused about presenting a true and fair picture of the financial statements. True and fair picture of what? The state of affairs on the balance sheet date and the profit and loss for the period ended on that date. So the basic idea is the financial statement, the balance sheet, profit and loss should reflect true and fair picture. The profit should not be overstated, the losses should not be understated. So nothing needs to be molded for determining target profits and losses of the entity. The assets and liabilities should reflect a true picture. It is neither overstated nor understated. So it should not be like this. If the entity has to make sound its financial statement, so the entity is going for revaluation of fixed assets at a one period, just for showing its balance sheet strong. So the perspective and focus should be true and fair. So the entity should be vigilant, the entity should be prudent while finalization of accounting policies. And the prime consideration is, and the primary issue is, the accounting policies which an entity is adopting should help the entity in preparation and presentation of a true and fair financial statements. So for presenting a true and fair view of the financial statement, major considerations are as follows. So which are the major consideration? The major consideration is, the first consideration is prudence. So what is meant by prudence? Prudence means recording income on a certain basis, not on anticipation, and all anticipated expenses and losses are provided for. So what does it mean? It means that the entity needs to recognize income only when the realization is certain, when the income is certain. The anticipated income has not been recognized, but the entity has to make provision for all anticipated expenses and losses. The classic example of prudence is valuation of inventory at a cost and market value, or a cost and net realizable value, whichever is lower. So accounting standard 2 on inventories states that the entity has to value the inventory on a reporting date or on a balance sheet date at a cost or net realizable value, whichever is lower. So going by the prudence concept, the entity is valuing its closing stock at a value which is not more than market value. So it is at a lower of cost or market value, whichever is lower. So if cost is lower, it has to be stated at cost. If market value is lower, it has to be stated at market value. So we are accounting for the anticipated losses, but we are not accounting for the anticipated income. So why the anticipated income has not been accounted for? If the entity can account for the anticipated income, it will result into the overstatement of profits, and might be the case those overstated profits got distributed as a dividend or as a return of capital. So if the entity is not able to realize those income in future, then it will lead to erosion of capital, because in real sense the entity has not made any income, because the entity has recorded that income which was never certain. So that is why, just to make the financial health of an entity in a prudent and in a viable manner, going by the prudence concept, the anticipated income has not to be accounted for, but all anticipated expenses and losses has to be accounted for. Substance over form. So what is the meaning of substance over form? It is the second criteria, or it is the second consideration for finalization of an accounting policies. So substance over form means transactions and events should be governed by their substance. It means their actual facts, not merely by legal form. Like, the entity sold its land to a party at a below market rate with a condition that I am refurnishing my example. Entity A has sold a land to entity B at a price of 50 lakhs with a condition that it will buy this land after 3 years at a price of 55 lakhs, and entity B is not allowed or has not having any right to sell this land to anyone else. So it has made a contract with entity B. Now the entity A is selling this land at a lower price which it could fetch by selling it into the market, and the future price is also decided that after 3 years entity A will pay 55 lakhs to entity B and get that land. So going by the legal form, it is a sale and purchase transactions. So entity A is selling land, so it has to book the sale transaction, and after 3 years when entity A will purchase the land from entity B, then it has to book a purchase transaction. But going by the actual facts, it seems like that entity A has borrowed funds with a security of that land given to entity B, and after 3 years the entity A will repay its debt of 50 lakhs along with an interest of rupees 5 lakhs. So going by the substance, it is a borrowing transactions, not a sale and purchase transactions. So the transactions and events should be looked at by its substance, not merely by a legal form. So this should kept in consideration while finalization or selection of accounting policies. The third one is again a very important concept, materiality. So materiality, going by the materiality consideration, it means disclose all the items the knowledge of which might influence the user of financial statement. So materiality means the entity has to disclose all the relevant items, all the material items, the lack of which, if it got missed or the entity has not disclosed those material items, the decision of the stakeholder or user can influenced while reading the financial statements. Just an example, contingent liability. So the entity A is having a balance sheet size of 100 crores. So the entity, a customer, has filed a legal suit against entity A claiming an amount of rupees 50 crores, which is a material amount. So it is still into litigation and the verdict has not been announced, the decision has not been announced, and the company is fighting the case against the customer. So the entity A or the entity is not thinking it material to disclose this fact in the notes to accounts of its financial statement. So a user, while reading those financial statement, is looking at the balance sheet, P&L, notes to accounts, is interpreting that the company, the financial health of company is very good, the company is free from all the litigations and all the problems, etc. So we can invest in this company. But he is not aware about that litigation, about that suit which a customer has been filed and claiming a claim of rupees 50 crores. If the entity has disclosed this fact, in that case the interpretation of that user will be different what he was interpreting earlier. So this is a material item, and all material item which can influence the decision of the users regarding financial statement needs to be disclosed, and it is considered to be material. So one classic example of materiality is Schedule 3 of Companies Act 2013 states that the entity has to disclose all items which is higher of rupees 1 lakh and 1% of turnover or 1% of revenue. So let's say the revenue of an entity is 1 crore. So 1% of 1 crore is 1 lakh. So in this case 1 lakh and 1 lakh is higher. So the entity has to disclose all item which is more than rupees 1 lakh separately in the notes to accounts or in the balance sheet or profit and loss account. So these are the three concepts: prudence, substance over form, and materiality, which needs to be taken into consideration while finalization of accounting policy. So far we have learned why this standard has been issued, what was the objective of this standard. So what is meant by accounting policy? So accounting policies are nothing, it is the specific principles and methods applied by an entity for those principles, while using those principles while preparation of financial statement. So we have understood the areas or circumstances where there are different accounting policies, and those accounting policies needs to be disclosed. So we have seen an illustrative list. Then we read that what should be the consideration which needs to be applied while finalization of an accounting policy. So we have read that the accounting policies should be framed in such a way that it will reflect the true and fair picture of the financial statement. And there are three major considerations which will support the entity in presenting the true and fair view of the financial statement. So one is prudence, the second is substance over form, and third one is materiality. Now coming to the disclosure of accounting policy is very important and very relevant para. Even the name of the standard is disclosure of accounting policies, and how accounting policies are going to be disclosed. So we will read in this slide. All significant accounting policies should be disclosed. So mind this, the word is all significant. So it does not mean that the entity is reporting into crores. Let's say Reliance Industries Limited, which is reporting its numbers into crores. So Reliance is having a turnover close to 3 lakh crores. So the entity has made an expenditure of, let's say, 50 lakhs rupees. So framing an accounting policies on that different expenditure is not correct. It is not significant. It is not material for the entity like Reliance Industries Limited. So all significant accounting policies, the significant material accounting policies needs to be disclosed. So the entity has to disclose all significant accounting policies. Such disclosure should form part of the financial statement. So where the entity has to disclose those significant accounting policies? In financial statement. In which part of the financial statement? In balance sheet? No. In profit and loss account? No. In cash flow statement? No. Then where? So it should be in notes to accounts. All disclosure should be made at one place. So very important part. So all disclosure should be made at one place. So very important. So if you have seen any financial statement after balance sheet, profit and loss, cash flow statement, there is a section called notes to accounts where the entity is providing explanatory information to the balance sheet, P&L and cash flow statement. So notes to accounts, in the first section of notes to accounts, the company is giving a section of significant accounting policies, and all the significant accounting policies is given at one place under the section of significant accounting policy. So the disclosure should be made at one place. Disclosure of accounting policies cannot remedy a wrong or inappropriate treatment of the item in the accounts. So let's say the entity has disclosed accounting policies. The entity has framed accounting policies and disclosed that accounting policies. But that accounting policy is not correct and it will lead to misleading results of an entity, or let's say wrong treatment or inappropriate treatment of a particular item in the books of accounts. So the entity cannot take a plea that I have already disclosed my accounting policy and it is not a remedy that wrong or inappropriate treatment of that item in the accounts will be okay. So the entity has to rectify that. Only merely disclosure is not sufficient. So these are the 4 disclosures. So all significant accounting policies should be disclosed. Such disclosure should be in the notes to accounts of the financial statement. All disclosure should be made at one place. It should not be scattered. It should be at one place, and the disclosure cannot remedy a wrong or inappropriate treatment. Now coming to fundamental accounting assumptions. So as far as fundamental accounting assumptions or basic accounting assumptions are concerned, so why these are called as a fundamental accounting assumptions? These are called as fundamental accounting assumptions because it is those assumptions which is assumed. So the entity need not disclose, or the entity need not separately state that we are assuming these assumptions. These assumptions are self-assumed. So which are these assumptions? So going by the fundamental accounting assumptions, the first one is going concern. So the entity should be regarded as a going concern until and unless the entity has explicitly states that it is not a going concern. Otherwise, the entity will be assumed as a going concern. What is meaning of going concern? We will see in the next slide. Consistency. So the entity has to maintain consistency while reporting from one period to another period. The accounting policy should be consistent. Accrual. The company has to record income and expenses on the basis of accrual, not on a cash basis. So these are the 3 assumptions, these are the 3 basic assumptions which an entity is expected to adhere to. So these are the basic and fundamental assumptions. Now coming to going concern. So coming to going concern, it is assumed that the entity or enterprise will continue its operations for the foreseeable future. So it is self-assumed that the entity will run in the foreseeable future. The enterprise has neither the necessity for the intention of nor the intention of liquidation. So the enterprise is not required to sell off its business, neither there is intention of the entity to go for liquidation or of cut down its material operations. So the first thing is the entity will assume to be run for ever in the foreseeable future. The second thing is the enterprise has neither required to sell off its operations, or it is not at all required, or the entity is not having any intention of liquidation, or the entity is not curtailing its material operations. If these three things are not there, then the entity is assumed to be going concern. Coming to consistency. So it is assumed that the accounting policies are consistent from one period to another. So whatever the accounting policy an entity is using in one period, that entity will use same policy in the another period as well. Just for the qualitative characteristics of the financial statement, a user, when the policies are consistent, a user or stakeholder is able to make a better comparison in the performance or state of affairs of an entity within a period or period. So when the accounting policy can be changed, the accounting policies can be changed. Change is allowed only when it is required by a statute or a law. So there is a new statute or law comes in the country which emphasizes to change in accounting policy. So if it is required by a law, then change is permitted. Second, if it is required by an accounting standard. So the accounting standard has been changed, the accounting standard is revised, and it is a need of accounting standard that accounting policy should be changed. Then it is allowed. So change in accounting policy is allowed. The third criteria is for the sake of better or more appropriate presentation. So in the last year, according to the size and operation of the entity, the policy which the entity has used last year is viable, is okay for its financials. But looking at the size and operations of that entity in this year, that policy is not considered, or that policy is not viable or appropriate from the operation per se for this year. So in that case, the entity can change its accounting policy for better or appropriate presentation. Now coming to accrual concept. So accrual means the transaction is required to recognize whenever it is going to be accrued. So not on a cash basis. So revenues and costs are recognized as and when earned or incurred, and not as money is received or paid, and recorded in the financial statement of the period to which they relate. For an example, the entity has sold goods on credit in the financial year 15-16. So in this case, the entity has recognized a revenue from sale of goods in the financial year 15-16 only, and the entity has recognized a debtors in its balance sheet or a trade receivable on its balance sheet. So whenever the money will receive in the next year, so that debtor will be credited and bank account or cash will be debited. So second example, the entity has paid an insurance policy in January. So the entity, the financial year ending is March, the entity has incurred an expenses on insurance policies for 1,20,000. So the insurance premium is for 12 months, and the entity has incurred this expense in January, in the month of January. So in this case, the premium is accrued only for the 3 months in this financial year. So for 3 months, 1,20,000 divided by 12 multiplied by 3, the entity has to recognize an insurance expense of 30,000 in the current month and a prepaid expense of 90,000 in the balance sheet. So going by the accrual concept, revenue and cost are recognized as and when incurred or earned, not as and when received. Even Companies Act 2013 mandatorily states the companies to use a mercantile or accrual basis of accounting, not a cash basis of accounting. So if the entity is using any cash basis of accounting, then the entity has to state or mention this fact in its financial statement, because it is against the fundamental accounting assumption. So disclosure of deviation from fundamental accounting assumption. So fundamental accounting assumptions, if the fundamental accounting assumptions are followed in financial statement, specific disclosure is not required. So the entity is expected to adhere to fundamental accounting assumptions. So the entity does not write that we have applied fundamental accounting assumptions. But if the fundamental accounting assumptions is not followed, then the facts should be disclosed. So if it is followed, then the entity has to do nothing. So if the fundamental accounting assumptions are not followed, then disclosure is required. So if the entity is not a going concern entity, it is not applying consistency principle, it is not applying accrual principle, then this fact needs to be disclosed in the financials of an entity. So coming to case study 1, Moon Limited has disclosed the significant accounting policies adopted in the preparation of financial statement with the respective notes. Like policy on fixed asset has been disclosed with the note on fixed assets. Policy on revenue is disclosed with the note relating to revenue from operation. So what the accountant of Moon Limited did, he has written the accounting policy with every note on the item of financial statement. Like below the note of fixed assets, he has written down the policy of fixed assets. Below the breakup or note on revenue, he has written down the policy on revenue. The accountant is of the view that it will give a true and fair picture for the user of financial statement. So whether accountant of Moon Limited is correct? No. The accountant of Moon Limited is not correct. Why? Because the disclosure of significant accounting policies should be made at one place, not with every note. So that is why the accountant is not correct. Coming to case study 2, Sun Limited has made a deposit with bank for rupees 5 lakh. So Sun Limited has done a fixed deposit with a scheduled bank, let's say State Bank of India, for rupees 5 lakhs, and he has not received interest till the end of the financial year. So the interest has accrued but not received. The accountant is of the view that the interest is due to be received in the month of April, and then he will book the interest. Whether accountant of Sun Limited is correct? Again, the accountant of Sun Limited is not correct. Not correct. Why? Because going by the fundamental accounting assumptions, there are three fundamental accounting assumptions: going concern, consistency, accrual. So the interest needs to be recognized on accrual basis, not on cash basis. Now coming to lesson summary. So what we have learned in this standard, so this was the very basic standard, and this standard is mandatory for every enterprise, every entity, and this is one of the fundamental and standard while preparation of financial statements. So we have learned what is the meaning of accounting policies. So accounting policies are nothing, it's a specific principles and methods applied to use those principles while preparation of financial statement. So what are the consideration in selection of accounting policies? So the prime consideration is that the accounting policies which the entity is going to select should support in presenting true and fair view, and in supporting to present a true and fair view of the financials, there are three consideration. One is prudence, the second one is substance over form, and third one is materiality. Then we have learned fundamental accounting assumptions. So every entity is expected to apply fundamental accounting assumptions. The disclosure of following fundamental accounting assumption is not required. If the entity is not applying fundamental accounting assumption, then this facts needs to be disclosed. So there were three fundamental accounting assumptions: going concern, consistency, and accrual. Then we have learned about disclosures, like all significant accounting policies needs to be disclosed, and such disclosure should be in notes to accounts in the financial statement. So all disclosures should be at one place. So for every for a change in every accounting policies, if there is a material bearing on the financial statement, if there is a material impact on the financial statement, such impact needs to be disclosed. For an example, the entity has applied for valuation of inventory, the entity has applied weighted average method in the current year in comparison to FIFO method from the last year, and this has leads to a reduction of rupees 30,000 in the valuation of closing stock and in profit of the entity for this year. So that 30,000 is a material amount for that entity. So let's say turnover of that entity is only rupees 5 lakhs, so 30,000 is a material amount for that entity, and the entity has to disclose such fact that while moving or changing from FIFO method to weighted average method, the closing stock and profit is reduced by rupees 30. So thank you very much.